What is capital adequacy? It's an often used expression. Capital adequacy basically means a bank that undertakes banking activity needs to have a minimum amount stipulated by government regulation, a minimum amount of its own money, its shareholders' funds. Think of that as the equity of the bank. A bank holds that equity or capital reserve so that every time a loan defaults, anytime any of its customers, its borrowing customers, default on their loan, that loan is money that has been lost by the bank, and that money, it comes out of the bank's capital reserve. So you can see that if you didn't have sufficient capital adequacy, every time there were any defaults on your lending, the lending that the bank did, the bank would become bankrupt if there wasn't sufficient capital to absorb those losses. So capital adequacy refers to the fact that a bank needs to hold a minimum amount of its own money at all times, and that minimum is given by government regulation.